Good afternoon. This is the Tech Report. The big story this week, of course, is the Twitter IPO. Twitter is expected to go public this Thursday at the New York Stock Exchange with a $1.6 billion offering and pricing the shares between $23 and $25. Now, most people won't get a chance to buy Twitter until it starts trading, and the stock could easily double or triple right away. So how does the average person trade Twitter if they want to? Well, joining me now is Donovan Lazar. He's the general manager of the Online Trading Academy. So Donovan, how high could Twitter go on that first day?
You know, it's hard to tell. I mean, Twitter can very easily do nothing. It can pop. It could go to $100 a share. I think the problem that most people are going to have is where to get in. And what we tell our students, Online Trading Academy, what I tell people is very simple. Stay away. There's going to be a lot of emotion in the stock. There's going to be an enormous amount of volatility, which is good for trading. But when it's erratic volatility, it's not good. And the emotions, fear and greed, are going to play huge roles in the initial rollout of Twitter. So I suggest let it settle in, let it die down, and then find levels of supply and demand, not to be confused with support and resistance, supply and demand, which is really where banks and institutions are buyers and sellers. There's two sides of the market, retail, banks and institutions. The question is, which side do you want to be on? If you're playing the IPO, you're getting right into the mix of the retail investor and all that emotion. So I would stay away and let it settle down and look at it as it settles into whatever level it's going to.
A lot of companies, when they go public, they do a secondary, usually 6 months after the fact, and that tends to pull the price down because now it's diluting the original owners. So is that maybe a good time for people that want to do this to sit back and wait?
That's a much better time to do it. Not necessarily perfect, but it gives the stock time to, again, settle in. You've got more shares that are now coming to the market, so you have institutions, again, selling. So you have to look into that as well. But what you have is a stock that has settled into a price that now you can actually look at high probability transactions. So you're looking for high quality levels of demand and supply to either be a buyer or seller. And you're going to have that 6 months down the road, 3 months, 4 months down the road. So anytime a secondary offering comes out, it's as the stock is stabilized and you're able to make those decisions much clearer.
One of the big criticisms about Twitter has been that its ability to make money is questionable. People look at LinkedIn and they had a clear source of revenue. They looked at Facebook and Facebook proved that they could make money within the first year. But Twitter, there's a lot of questions as to whether they can make any money or make any money going forward.
Yeah, I agree. I think that's the big question. Their value is their database, their names, their customers. It's a question of, can they monetize it? Facebook clearly has done that, and they will continue to do that. LinkedIn has done that, and they will continue to do that. Twitter needs to find, whether it's via acquisition or new products or whatever it might be, to be able to monetize that database. And if they can figure that out, they will do very well. But it's still a clear question of what does that mean? Because again, you already have Facebook, you have LinkedIn, you've got all these other companies doing it. So Twitter needs to figure out how to do that. And if I were a betting man, I'd say it'd be through acquisition.
All right. Well, it's definitely going to be a crazy day when it goes public. And of course, the street's going to be there on the floor when Twitter goes public. That's Donovan Lazar. He's from the Online Trading Academy. And I'm Deborah Borchardt with The Street.